Today we are going to continue from where we stopped last time on the make or buy decision. We have discussed the underlying concept of make or buy decision. I will just have a recap on what we did last time. We said that make or buy decision is a decision that is usually taken when a company is contemplating on whether a particular raw material, sub-assembly, or component requires for the manufacturing of the company's final products should be manufactured internally or contracted to an outside supplier. A company wants to know whether a raw material, sub-assembly, or a component required for its final products should be produced internally or contracted to an outside supplier. And I said that this kind of a decision is very critical and strategic because of the need to protect the degree of secrecy or the proprietary information underlying the company's product, because every product is unique. Therefore, before decision is taken as to whether to contract it to an outside supplier or not, the company must be ensured that the proprietary technology or information that is associated with the product or components is protected. Now, and I said that under make or buy decisions, you are going to analyze the situation in two perspectives. One is the economic angle, then two is the qualitative factors. Under the economic angle, I said the most important thing you need to do is to compare the supplier's quotation versus the relevant cost of making the component, whether it will result in a saving or deficit to the organization. All right. So if the supplier's quotation is greater than the relevant cost of making the component, then your advice should be that the company should make the component. But if supplier's quotation is less than the relevant cost of making the component, then it is cheaper for the company to buy from outside supplier. And I also said where the supplier's quotation will be equal to the relevant cost of making, the company can decide to either make or buy the component depending on other qualitative factors. And I gave you about 7 qualitative factors that you need to take into consideration, particularly when it has to do with make or buy decision. You are going to look at the qualitative factors in 2 different angles. One, you look at the perspective of the company. If the company wants to decide to make the component internally, what are the factors that needs to be taken into consideration? Then 2, you also need to consider the perspective of the supplier. If you want to contract the manufacturing of the component to outside supplier, what are those factors that you need to take into consideration? These are the things we discussed last time. And one of the factors that I mentioned was that there are some germane questions that will be begging for answers. One of them is that the company will need to confirm. As a company, you need to ask a question that do we have the technical know-how or expertise to produce the components in-house? All right, because you can't just say because you have so much financial resources and then you want to start producing. You must ensure that you have the capacity, all right? You have the technical know-how or expertise to produce, all right? That's number 1. Then 2, as a company, you need to find out if you have the requisite manpower, okay? If you have the requisite or the required manpower to produce the component in addition to the existing products, okay? So you need to find out if the company has that capacity. Then number 3, the company will need to confirm if the law of the land permits the production of the component, all right? So you need to, as a company, you need to find out, are we permitted by law to produce the components, okay? That's number 3. Then number 4, as a company, you also need to protect the degree of secrecy or the proprietary information or technology underlying the products. Okay, that's another factor you need to take into consideration. I said the need to protect the degree of secrecy or proprietary technology underlying the products. All right, because if you decide to contract with an outside supplier and the supplier leak your secrets, the secret of your products, leak it to your competitor, that means the company will be out of business. So you need to protect that. Then number 5, the need to maintain and ensure better quality control of the product or of the components. That's another factor that needs to be taken into consideration. If the company cannot guarantee that the supplier will produce a better quality product or component, then it's better for the company to produce internally. Those are some of the factors you need to consider on the perspective of the company. Let me add additional two on the perspective of the contractor. One factor you need to take into consideration on the perspective of contractor is that the company will need to ask this question: do we have a reliable supplier who can deliver according to specification? The way you want your product or your component to be, can the do you have a reliable supplier who can deliver according to how you want it, according to your own design? All right, that's number one factor. The second factor to consider on the perspective of the supplier is, do we have a reliable supplier who can satisfy the existing capacity level, such that any quantity of the component that is required is what that will be delivered. So not that if you say, for example, you need 100,000 kilograms of the component, the supplier will tell you that, please, I will bring 60,000 now, then a balance of 40,000 will come in the next few hours or few days. No. So you must ensure that you have a reliable supplier who can satisfy your existing capacity level. Okay. So these are some of the factors that you need to take into consideration. You can go to the ebook, the PDF. There are so many factors I put in there. So let's move on. And that's where we stopped last time. Then we now have an illustration. We solved this illustration number 1. All right. We solved that illustration number 1. So let's have another illustration now. Let's have another illustration. Let's have another illustration. So I need somebody to read illustration number 2. Okay. I need somebody to read illustration number 2. Okay. We are going to solve the entire illustration under this. So one of you should help us to read illustration number 2.
Scroll down.
Okay. Okay.
Good afternoon, everyone.
Grace. Good afternoon.
Dangote Nigeria Limited produces and sells to wholesalers a highly successful line of summer lotion and insect repellents has decided to diversify in order to stabilize sales throughout the year. A natural area for the company to consider is the production of lotions and creams to prevent dry and chapped skin. After considerable research, a product has been developed. However, because of the conservative nature of the company management, Dangote management has decided to introduce only one of the new products for the coming season. If the product is a success, further expansion in future years will be initiated. The product selected, called Chap Off, is a lip balm that will be sold in a lipstick-type tube. The product will be boxed. Because of the available capacity, no additional fixed charges will be incurred to produce the product. However, 100,000 naira fixed charges will be absorbed by the product to indicate fair share of the company's present fixed costs to the new product. Using the estimated sales and production of 100,000 boxes of Chap-Off as the expected volume, the accounting department has developed the following costs per box. Direct material, okay, the information below is said to be correct. Dangote Nigeria Limited has approached a cosmetic manufacturer to discuss the possibility of purchasing the tubes for Chap-Off. The purchase price of the 24 empty tubes in a box from the cosmetic manufacturer is 90 kobo. So sorry, 90 kobo. With this purchase proposal, it is predicted that direct labor and variable overhead costs will be reduced to 10% and direct material costs will be reduced to 20%. Required: 1. Should Dangote Nigeria Limited make or buy the tubes? Show calculation to support your answer. Number 2. What would be the maximum purchase price acceptable to Dangote Nigeria Limited for the tubes? Show calculation to support your answer with an appropriate explanation. Number 3. Instead of sale of 100,000 boxes, revised estimate shows sales volume of 125,000 boxes. At any volume above 100,000 boxes, additional equipment at an annual rental of 10,000 naira must be acquired. Under these circumstances, should Dangote Nigeria Limited make or buy the tubes? Show calculations to support your answer. Number 4. The company has the option of making and buying at the same time. What would be your answer to requirements? Number 3. If this alternative were considered, show calculation your answer.
Thank you. That is the question the examiner is asking you. You can see from the first requirement, examiner is asking, should Dangote Nigeria Limited make or buy the tube? Which means that this question relates to make or buy. So what are you supposed to do? Simple. Just compare supplier's quotation versus relevant cost of making the tube. All the data given to you in this question is based on the activity level of 100,000 boxes. All right. Okay, it's based on activity level of 100,000 boxes. So what that simply means is that, of course, the first thing you need to do, you go to the question and identify the supplier's quotation. All right. So according to the question, when Grace was reading in the last paragraph, you see where I underlined. You are told that Dangote Nigeria Limited has approached a cosmetic manufacturer. That cosmetic manufacturer is the supplier. Okay, it's outside supplier. So then you are now told further that the purchase price of the 24 empty tubes in a box from the cosmetic manufacturer is 90 kobo. That 90 kobo is the supplier's quotation, okay, per box. That's the supplier's quotation per box. So you're now told further that with this purchase proposal, it is predicted that direct labor and variable overhead costs will be reduced to 10%, while direct material costs will be reduced to 20%. So simple. What am I supposed to do? I've already found the supplier's quotation to be 90 kobo per box. Then all I need to do now, I can decide to either use absolute value or I use power value. If I want to use absolute value, I will just multiply the activity level of 100,000 boxes. I will multiply with 90 kobo. That will give me 90,000 naira. That will be the supplier's quotation versus relevant cost of making the tube. What is the relevant cost of making the for the entire box of the 100,000. I will take my direct material. According to the question, the direct material given in this table is 3 naira, direct labor is 2 naira, total overhead is 1 naira 50 kobo. 3 naira alone is more than the supplier's quotation of 90 kobo, and that's why the examiner told you that direct material should be reduced by 20%, should be reduced to 20%. Therefore, 20% of 3 naira will give me 60 kobo. 10% of 2 naira direct labor will give me 20 kobo. Then total overhead. I don't need total overhead is irrelevant. There are two types of overhead. We have variable overhead. We also have fixed overhead. Only the variable overhead is relevant. The fixed overhead is not relevant. Examiner has told me that the variable overhead should be reduced to 10%. And examiner did not give to me the variable overhead. So I should look for something there's an indication in the question that will enable me to get my variable overhead. So when you are faced with this kind of a question, you need to open your mind, all right? Think outside the box, because about first thing first, before you be able to think outside the box, you must know what you are doing. Then, because you know that examiner has told you that variable overhead should be reduced to 10% and the variable overhead is not given to you, then you should open up your mind that, okay, if I have total overhead and I know total overhead is divided into two, variable overhead and fixed overhead. I'm looking for variable overhead is not given to me in this question. Can I get fixed overhead? Yes, examiner has given you fixed overhead because in the third paragraph of the question, you are told that, however, 100,000 fixed charges will be absorbed by the products to indicate fair share of the company's present fixed cost to the new product, using the estimated sales and production of 100,000 boxes of chop-off as the expected volume. So if my fixed overhead is 100,000 naira at activity level of 100,000 boxes, I will just divide 100,000 naira by 100,000 boxes. That will give me 1 naira. So it means that my fixed overhead is 1 naira. Total overhead is 1 naira 50 kobo. My fixed overhead is 1 naira. That means my variable overhead is 50 kobo. I will now apply 10% on 50 kobo to get 5 kobo. That is what you are expected to do. But in any case, let me stop sharing this so that we can solve the question straight. Okay. So the name of the company is Shango Tedo Nigeria Limited. Solution to illustration 2. Okay. What page is that? So the name of the company is Shango Tedo Nigeria Limited. Number A, examiner is asking me whether they should make or buy the tube. So I will come here, saving or deficits from making the tube for chop off. So remember, under make or buy, the most important thing you need to do is to compare supplier's quotation. So I will then come here, supplier quotation. We have found that according to the question, supplier's quotation is 90 kobo. What I'm saying is that I can decide to use absolute figure or I can do power value. Whichever one I do, I'm going to get the same thing. It's the same decision I'm going to get. So if I want to use absolute value, I can say 100,000 boxes multiplied by 90 kobo, 0.90. This will give me 90,000 naira. So the total supplier's quotation is 90,000. I will now compare this with the relevant cost. relevant cost of making the tube for chap off in a box. So I would then say direct material 100,000 boxes multiplied by, examiners told us that direct material of 3 naira should be reduced to 20%. 20% of 3 naira is 0.6. Okay, 0.60. Let me do it this way. Multiply by 3 naira, multiply by 3 naira, multiply by 20%. Bring out the calculator. 100,000.
60,000.
Pardon?
60,000.
60,000. Okay, thank you. That's 60,000. Then direct labor. 100,000 boxes multiplied by 2 naira, reduced to 10%. This will be 20,000. Then variable overhead. Like I explained, examiner did not give us variable overhead. We are just told that the variable overhead should be reduced to 10%, but the variable overhead is not given itself, so we need to go and work it out. All right, this would be, let's say, our working week. Start from here, working. Hopefully, the space I've given will be sufficient. Working number 1, we want to determine variable overhead. So, like I said the other time, you need to think outside the box. You need to open your mind and think about what you are looking for. Examiner has given you total overhead of 1 naira 50 kobo, and you are told in a question that variable overhead should be reduced to 10%, and the variable overhead is not given to you. How do you then determine it? How do you determine your variable overhead? To get the variable overhead, you need to go through the question and think if you can, since you know that variable overhead, you know that overhead is divided into two, into fixed and variable. So you go to the question, if you can get fixed overhead. If fixed overhead is given, then you can quickly get your variable overhead. You are going to use the known variable to get the unknown variable. So I can come here to say total overhead, okay, per box is 1 naira 50 kobo. Then fixed overhead, we have identified from the question that we are given fixed charge of 1,000 naira at the activity level of 100,000 boxes. Okay, at the activity level of 100,000 boxes. So fixed overhead per box is 1 naira. If that is the case, the variable overhead is 50 kobo. That's what the examiner has hidden for you in the question. Now that you know the variable overhead, I can then proceed. So multiply by 0.5, 50 kobo, multiply by 10%. Examiner has told us that to reduce to 10%. Okay, this should be 5,000 naira. So add it up, no other cost again. Add it up. This is 85,000. This represents the total relevant cost. That's total relevant cost. This guy is A, this is B. If A is greater than B, then your decision should be that the company should make the tube. So I would then say decision. Okay. Shango Tedo, Nigeria Limited. Oliver, go ahead.
Yeah.
should make.
Just an observation, sir. You know
Talk
that
to me.
the value of the variable cost was hidden. We are only given
Yes,
the total overhead, and
yes,
now we are told that we should reduce it to 10%.
yeah.
So are we going to use 50 kobo instead of 5 kobo?
It's
Because
not 5 kobo now.
this is the value. This is the value of the overhead, which is 50 kobo. Because it could be stated in that question as 50 kobo, but
Yes,
it was joined with the total overhead. So if the question say reduce it to 10%,
10%.
yeah.
Yes.
So okay,
It's
I've seen what you
10%
did.
of five, it's 10% of 50 kobo now.
Okay, I've seen it here. I've seen it. Thank you, sir. I've seen it here. All right, thank you.
Yeah, well, it's okay. So this is what I mean by absolute figure. So if I want to do power value, like I said, we are going to get the same thing. If I want to do, let me even, before I put the decision there, let me rewrite this. So alternatively, I can decide to use power value. This is faster. This is what I will do on the day of exam if I'm the one solving this. All right. So supplier's quotation is 90 kobo, 0.90. And I will compare its relevant cost of making the raw material, which is 3 naira multiplied by 0.20, 60 kobo. Direct labor, 2 naira multiplied by 10%, 0.20. Variable overhead, 5 kobo multiplied by 10%, 0.10. That's 5 kobo. Add it up, 0.85. So this one will be faster. This is what I will do if I'm the one solving the question on the day of the exam. Relevant cost per tube. Okay, so my decision will then be decision. Shangutedo, Nigeria Limited should make the tubes. No need for story. If you want to go further, you can say Shangotedo Nigeria Limited should make the tube since supplier's quotation of 90 kobo is higher than the relevant cost of making the tube, 85 kobo. That's all. But just do it this way and you move on. So that is as per the first requirement. Requirement number 2 now. Requirement number 2. According to the question, you are asked that what will be the maximum purchase price acceptable to Shangotedo Nigeria Limited for the tubes? Show calculations to support your answer with an appropriate explanation. All right. What should be the maximum purchase price acceptable to the company? Of course, something that costs you as a company, this thing costs you 85 kobo. Somebody wants to give it to you at 90 kobo. Will you accept? So examiner is only asking you to repeat what you have done in the first requirement. So what you are supposed to do here, number 2, maximum purchase price. I will say maximum purchase price. Okay, maximum purchase price. That's the heading. I will then say the maximum purchase price acceptable to Shangotedo Nigeria Limited is 85 kobo per tube, representing the total relevant cost per unit or per tube, or represent the total relevant cost of making the tube. Okay, this is shown in the calculation below. This is shown in the calculation below. You now list all those direct material. Okay, maximum price. Direct material, which is 60 kobo. Direct labor, 20 kobo. Variable overhead, 5 kobo. Total 0.85. That's it. That's the maximum purchase price. Acceptable to you can't pay more than what it will cost you. All right. So number three, instead of sales of 100,000 boxes, revised estimates show sales volume of 125,000 boxes. At any volume above 100,000 boxes, additional equipment at an annual rental of 10,000 naira must be acquired. Under these circumstances, should Shangotedo Nigeria Limited make or buy the tubes? Show calculation to support your answer. Now, in the first requirements, like I mentioned, all the figures given in the question was on the basis of 100,000 boxes. Now, examiner is telling you that at any point above 100,000 boxes, additional equipment rental of 10,000 naira must be acquired. So with this circumstance, should the company make or buy the tube? So let's see. I will then go ahead. Number three, you need to compare supplier's quotation at the activity level. You compare supplier's quotation of 90 kobo at 125,000 boxes versus relevant cost of making the 125,000 boxes. All right. So I would say saving or deficits from making 125,000 boxes of chop-off. So we compare supplier's quotation. Let me write that. Supplier's quotation, because in this requirement number three, examiner has given to us equipment rental of 10,000 naira. Of course, your calculation should be based on absolute figure. So I would then say 125,000 multiplied by 90 kobo. This will give us 116,250. Please confirm the number. Then we compare this with relevant cost of making
112,500.
one what?
112,500.
No, 125,000 multiplied by 0.9.
412,500.
112,500. Thank you. 112,500. You are correct. So relevant cost of making the tube, the 125,000 I would then say direct material. Don't go and be looking for shortcuts because you have determined relevant cost to be 85 kobo. You then say 0.85 multiplied by 125. You get your answer, then you now have the equipment. If you do it that way, no worries, but it's better for you to follow the normal routes. Don't go and be looking for shortcuts. Direct material, which is 125,000 multiplied by 0.60. This is 75,000, okay? Then we have direct labor, 125,000 multiplied by 20 kobo. This should be 25,000. Please confirm. Then we have variable overhead, 125,000 multiplied by 10 kobo, no, 5 kobo, 0.05. What do you have there? That's
6,250.
6,250. Then we also have equipment rental, of 10,000 naira. We had it up. What's the total? This 116,250.
160.
Okay, so total relevant cost. Okay. This is A. This is B. With this circumstance, what do? Your decision should be that the company should buy the company or Shongotedo Nigeria Limited should buy the tube since supplier's quotation is lower than the relevant cost of making. Since suppliers quotation of 112,500 is less than the relevant cost of making. Oh, no space again. It's less than the relevant cost of making the tube of 116,250. Yes, Ablatif, you raised hand.
Sir, sorry, I just need you to help review that 5 kobo. That variable overhead, the calculation, please.
What about it?
I just need your explanation on it again, please.
According to the question, the examiner told you that variable overhead should be reduced to 10%. The variable overhead is not given to you in the question. And I told you there are two types of overhead. We have fixed overhead. We also have variable overhead. If you have told, in the examiner has told you, if no further information, you are just given total overhead. Like in this case, you are given total overhead of 1.50 kobo. If there's no additional information, you just ignore the overhead. The total overhead is not relevant. Only variable overhead is relevant. So since you have total overhead and you have to reduce variable overhead by 10%, and the variable overhead is not given to you, that means something should call your mind that it's like this thing is hidden somewhere. So I need to go and look for it. So you know that total overhead include variable and fixed. So variable is not given. Total overhead is given. Then I should be able to get fixed overhead. If I get my fixed overhead, I will use it to get my variable overhead. Then we went into the question. we find that examiner told you there is a fixed charges of 100,000 naira at the activity level of 100,000 boxes. So that will give you your variable, will give you your fixed overhead per unit, per box of 1 naira. So the total overhead is 1 naira 50 kobo. The fixed overhead is 1 naira. That means variable overhead is 50 kobo. So since I have my variable overhead to be 50 kobo, then I will multiply 10% on it to get the 5 kobo. All right, that's how we got the number. Is it clear now?
Sir, thank you, sir.
You are welcome. Yes, let's move to number 4. Requirement number 4. According to the question, you are told that the company has the option of making and buying at the same time. What would be your answer to requirement number 3? If this alternative were considered, show calculation to support your answer. Okay, so in this requirement number 4, the company has the option of making and buying. It's not option of making or buying. Option of making and buying at the same time. So in this case, what are you supposed to do? Examiner is referring to requirement number 3, where you have 100,000, where you have 125,000 boxes. You want to produce 125,000 boxes, and the company has the option of making and buying at the same time. What are you supposed to do? Yes. Who can guide us? What are we supposed to, how are we going to solve that requirement? Yes? Who is talking? Oliver, yes, talk to me.
Okay, what I think about this question is this. You know that at the activity level of 100,
Yeah.
it pays the company to produce in-house.
Okay.
But when the activity level increased from 100 to 125, it was better for them to buy. So when we look at that increase of 25, we found out that because we are going to increase the activity level, we are going to incur an additional 10,000 naira.
Yeah.
You understand? So the best thing we can do is, first, we produce in-house 100, then we are source 25. By that way, we will save 10,000 naira.
Yep. You are correct, Oliver. Thank you. That's what we need to do. So let's make an option. For option number 1, for example, option number 1, the company referring to it because examiner was referring to requirement number 3. So option number 1, the company decide to buy 125,000 boxes. Okay, at the total cost of 112,500. That's one option. Option 2, the company can decide to make the entire 125,000 boxes at 116,250. Option 3, this is the one the question asks you to do. The company can, according to Oliver, the company can make 100,000 boxes. Of course, at 85,000, at 85 kobo, at 85 kobo, 0.85. That will give us 85,000. Then the balance of 25,000 boxes should be bought. With this, the company is going to save the equipment renter of 10,000 naira. So when you multiply, what do you get? 25,000 multiplied by 0.9. That's 22,500. When you add it up, 107,500. So this is the option to make and buy at the same time. You can see this one is if the company decides to buy the entire 125,000 boxes, the company will incur 112,500. If the company make the 125,000 boxes, the company will incur 116,250. But if the company makes 100,000 boxes, the company and then buy the balance of 25,000 boxes, the company will incur 107,500, which is cheaper. So final decision. Okay. Shongotedo, Nigeria Limited should make 100,000 boxes at 85,000 naira and buy 25,000 boxes at 22,500. That's our decision. So that's end of the question. Let me know if you have any question before we move to the next one. Okay, so let's move to illustration number 3, under make or buy. Okay. Let's solve this illustration number 3. Somebody should help us. Who will help us to read it? Oliver, go ahead.
Okay, illustration number 3. Divine Grace Limited currently make as many units of parts 2011 as it needs. The company has recently received a bid from another company, KKPLC, for making parts 2011. The company will supply 1,000 units of parts 2011 per year at 100 naira a unit. The company can begin the supply and continue for 5 years, after which time Divine Grace Limited will not need the parts. KKPLC can accommodate any change in DG Limited's demand for the part and will supply it for 100 naira regardless of the quantity. Ayo Ayuba, the cost accountant, reports the following cost for manufacturing 1,000 units of parts 2011 as follows. The following additional information is available. 1. Part 2011 is made on a machine used exclusively for the production of parts 2011. The machine was acquired on January 1st last year at a cost of 120,000. The machine has a useful life of 6 years and zero terminal disposal value. Price. Depreciation is calculated on a straight line method. 2. The machine could be sold today for 30,000 naira. 3. Product and process engineering costs are incurred to ensure that the production process for Part 2011 works smoothly. Although these costs are fixed in the short run with respect to units of Part 2011 produced, they can be saved in the long run if Part 2011 is no longer produced. If Part 2011 is at source, product and process engineering cost of 8,000 will be incurred for the next year only. 4. Rent cost of 88,000 are apportioned to the product on the basis of the floor space used for manufacturing the product. If Part 2011 is discontinued, the space currently used to manufacture it will become available. The company could then use the space for storage purpose and save 2,000 naira currently paid for outside storage. 5. General overheads are apportioned to each department on the basis of direct production labor cost. This cost will not change in total, but no general overhead will be apportioned to Part 2011 if the part is a source. Assume the required rate of return is 12%. Required. Should DG Limited outsource Part 11? B. What maximum price should KK Limited quote on the 1,000 units to make Divine Grace indifferent between outsourcing and internal production? C. What non-financial factors would factor internal production? Sorry, what non-financial factors will favor internal production rather than outsourcing?
Thank you, Oliver. That
Welcome.
is the question. The A part of the requirement says you should DG Limited outsource Part 2011? Before you can answer that question, you need to compare the supplier's quotation versus relevant cost of making Part 2011. One thing is strange in this particular question. Examiner has given you a cost of capital of 12%. When you are given a cost of capital, it is expected that you are going to discount the future cash flows to the present value equivalent. All right? That is, you incorporate time value of money into your cash flows. Now, when this question was tested, most of the students did not attempt it because they could not understand. They didn't understand the question, and the few of them that attempted the question could not score above average. According to the examiner report, the students, those few students that attempted the question scored below average performance. Why? Because most of them could not apply the discount rates. It was a strange kind of a question. And ordinarily, if I'm the one solving the question and I don't understand this, there is no even need, because I have other options. There is no need for me to be wasting my time. Instead of scoring below, I'll just move on to the next one. But the bottom line is that when you are given a cost of capital, like in this case, 12% rate of return is the same thing as cost of capital. So once you have this, it means that you need to discount the future expected cash flows. So how do you then solve this question? And you know that under make or buy, the most important thing you need to do is to compare supplier's quotation versus relevant cost of making the Part 2011. But this question goes beyond that, because examiner has given you cost of capital of 12%. Therefore, what you are supposed to do is to identify the variables that relate to outsourcing Part 2011. Then you also identify the variables that relate to internal production. Once you have all the variables that you need for each of them, then you now discount it at 12% to get the present value. So the total present value under outsourcing minus the total present value under internal production will give you either saving or deficit, okay, from making Part 2011. All right, so that will be based on your decision. Of course, until that is done, then you can then move to number B. So without wasting more time, let me stop sharing this and move to calculating the solving the question. Okay. Solution to illustration number 3. Okay. Divine Grace Limited is the name of the company. Number A requirement, examiner wants you to advise whether DG Limited should make or buy Part 2011. All right. So what are you supposed to do? Like I said, the first thing in this kind of a situation, since examiner has given to you cost of capital, the most important thing you need to do is to identify the variables that you are going to need under outsourcing. Then second part, you also need to identify the variables you are going to need under internal production. You now discount you calculate present value for outsourcing. You also calculate present value for internal production. Then you now find the difference between the two. So first thing first, for outsourcing, if the company decides to outsourcing part 2011, so what are those things? What are the variables you need to consider? I will then go back to the question. Okay, go back to the question. Begin to read one after the other. From the first paragraph, you are told that the company will supply, KKPSC will supply 1,000 units of part 2011 per year at 100 naira a unit. So you need to determine supplying cost. So I will then come here, supplying cost, we are told is we want to KKPSC will supply 1,000 units at 100 naira per unit per year. So this is 100,000 naira. This 100,000 naira is per year. Now, pay attention, please. Because examiner has given to you the cost of capital, you are going to need, there are three variables when you want to discount, when you want to calculate present value, there are three variables that must be present. One is the useful life. Two is relevant cash flow. Three is the appropriate cost of capital. So examiner has given to you cost of capital of 12%. The cash flows are there. You are the one that will determine the relevant cash flow that you need. Then three, the useful life. So for each of the line items you are going to need, you must be able to identify which number of years are you going to use for each of them. Like in this case, the supplying cost, examiner told you, is per year, and the period of the contract is 5 years. So that means this 100,000 naira will be constant from year 1 up to year 4 to be constant 100,000 naira. So I will go back to the question again. Going to the second paragraph. You are told that Ayuba, the cost accountant, report the following cost for manufacturing 1,000 units of part 2011. So all this item relates to the, yes, as determined by the cost accountant. I don't have anything to do with all of that, but later on I will come for that. All those direct material, direct labor, whatever. Then you are now told further that the following additional information is available. Part 2011 is made on a machine used exclusively for the production of Part 2011. The machine was acquired on 1st January last year at a cost of 120,000 naira. That 120,000 naira, as you know, is a sunk cost. It's an historical cost, therefore it is irrelevant, you ignore it. The machine has a useful life of 6 years and 0 terminal disposal value. Depreciation is calculated on a straight line method. So here, examiner is just explaining to you how they arrive at the depreciation of 20,000 naira. So that depreciation of 20,000 naira is determined by dividing the original cost of 120,000 naira by 6 years, useful life. So that will give you 120,000 divided by 6 will give you 20,000. Depreciation is not a cash flow, therefore you ignore it. It's not relevant. Number two, all of this, as you are doing your calculation, you also state your assumptions. Why didn't you pick the 120? Why did you ignore depreciation of 20,000? You have to state all your assumptions. It's not just about you doing your calculation and rush and move to the next one. No, you must ensure that you maximize your mark. Number two, the machine could be sold today for 30,000 naira. This is disposal value, and you know that disposal value will represent a saving to the organization. Therefore, you send a message. So, therefore, now, at this point, you need to take a position, pay attention. this machine in question, examiner did not tell us who owns the machine. Is it the machine? Is it Divine Grace that owns the machine, or KKPSC? All right. Remember, when I was giving you the format of calculating relevant cost of making, that you have nothing to do with any disposal value. All you need to do is to just consider direct material, direct labor, direct expenses, variable overhead, opportunity cost, all those direct, incremental, attributable, specific fixed costs. Any cost that will be incurred purposely in making the component are the ones you should consider. So you are less concerned with disposal value. All right. So at this point, you need to make a decision who owns the machine. Since examiner did not tell you whether the machine belongs to DG or KK. So, and then since in our formats, we don't have anything like disposal value, therefore, it is assumed that it is KKPLC that owns the machine. So in this case, what are you supposed to do? Examiner told you that the machine could be sold today for 30,000 naira. Today means year zero. Because before you can count a year, before you can recognize a year, you must have counted 12 months, January to December. So today means year zero. Therefore, I would then come here, disposal value or machine disposal. Disposal value, this is a saving. So 30,000 naira. You put it in brackets because what you want to determine are costs. So you put it in brackets, you put the savings in brackets so that it will reduce the cost. Down. Examiner said today. Today means year zero. So that's that. All this thing I'm doing is not what the examiner asks you to do. I'm just teaching you the exam technique. What I'm trying to do is to bring out all the relevant variables that I'm going to need, which will make my job easier as I proceed in the calculation. Next item. Number 3. So whatever the assumptions you have made, you have to state all of them. Number 3, product and process engineering costs are incurred to ensure that the production process for Part 2011 work smoothly. Okay, so what that means is that if the company does not incur product and process engineering costs, they won't be able. There won't be smooth production run. Although these costs are fixed in the short run, with respect to units of Part 2011 produced, they can be saved in the long run if Part 2011 is no longer produced. Okay, if Part 2011 is outsourced, product and process engineering cost of 8,000 naira will be incurred for next year only. So that means product and process engineering cost will appear twice. So I will come here, products and process engineering costs. We are told is 8,000 under outsourcing. What is the period? Product and process engineering cost of 8,000 will be incurred for next year only. For next year only. Next year is year 1. So I would then say year 1 only. Okay? Year 1 only. Next item. Again, you have to state all your assumptions. Number 4, rent cost of 8,000 naira are apportioned. That 8,000 naira is irrelevant because any apportionment is irrelevant cost. Okay? If Part 2011 is discontinued, the space currently used to manufacture it will become available. Okay? The company could then use the space for storage purposes and save 2,000 naira currently paid for outside storage. So there's a saving of 2,000 naira. So I will then come here. I need to indicate that. Storage space. Again, saving 2,000 naira. So examiner has told you 2,000 naira. So that would be for the period of the contracts. So per year, they are going to save it per year for the period of the contracts. What else? Move on. Number 5, general overheads are apportioned to each department on the basis of direct production labor cost. Any apportionment is irrelevant. Therefore, the general overheads is irrelevant. This cost will not change it. We are less concerned with all of that. So we've already decided that it's not relevant. Any general overhead is not going to affect, no matter the decision taking, it's not going to change. Therefore, ignore it. So that is that as per outsourcing. Let's identify the variables that we need under internal production. Internal production of parts 2011. So what are the variables that we need? At this point, you then go back to your formats. Under the relevant costs, you need direct material. When you want to produce part 2011, direct material will be needed. And according to the question, direct material is 44,000 naira per annum. All the figures you have there are on the basis of 1 year per annum. Okay, then we have direct production labor. Direct production labor, we are told is 22,000 naira. Then we have variable overhead. How much is variable overhead? That is variable production overhead for 14,000. Variable production overhead is 14,000. Then we have products and process engineering. Examiner has told us that the product and process engineering will be incurred to ensure smooth production run. Okay, engineering, 8,000. Any other costs? All the remaining ones are irrelevant. You ignore them. So if that is the case, if I like, I can decide to add everything together. 44, 66, 80, 88. This is total relevant cost. If not because of the fact that examiner has given to us the cost of capital of 10%, of 12%, ordinarily what I will just do is to add up, I will get 88. I will also add up the under suppliers quotation. Whatever I have there, that's 70, 70, that's 78, 78 minus 2, that's 76, okay? That would be 76, I think. Yeah, that would be 76, 70, 78 minus 2, that's 76. So I will just add up everything, 76 compared to internal production of 88. It is very glaring that supplier's quotation is cheaper. I will just decide to buy it from outside supplier. But that's not the way we are going to do it, because the examiner has given us the cost of capital of 12%. So in this case, since I've identified the variables that I need, the next thing I need to do now is to calculate the present value of outsourcing, then present value of internal production. I need to incorporate time value of money. So I would then say PV for outsourcing parts 2011. So when you are calculating present value, what you are trying to do is to convert the future cash flows. All this cash flow, you want to convert it to the to present value equivalent. So you create a column for year, description of items, okay, description of items. Then you have cash flow. You have discount factor at 12%. Then you have the present value. So you now go to under outsourcing, all those variables that you have identified. The first item is supplying cost. So I would then say supplying cost. Supplying cost is 100,000 naira per annum. So year 1 to the period of the contract is 5 years. So this 100,000 will be for year 1 to year 5. So because the 100,000 naira is constant, then I need to go and calculate annuity factor. So let's go and do our working here. Working number one, you must know how to calculate annuity factor. Annuity factor is calculated when you have constant cash flow. So annuity factor is calculated as 1 minus 1 plus r raised to power minus n, all divided by r. So in this case, r is the cost of capital of 12%, n is the useful life. So for supplying costs, I will say 1 minus 1.12, that is 1 plus 0.12 will give us 1.12 raised to power. This 100,000 naira for supplying costs will occur for the next 5 years. So 5 years, here is minus 5 divided by 0.12. Mathematically, if you put your calculator, you should get 3.605. That's it. That's the annuity factor, or what is known as cumulative discount factor. Okay. So I will then go up there. This is 3.605. When you multiply that with 100,000 naira, that's 360,500. So I'm done with supplying costs. I will pick the next one, which is disposal value, saving. So I have a saving of 30,000 naira. I will then go back to my notes. That 30,000 naira, when is it going to occur? Examiner told us that today it will be disposed of at 30,000 naira today. Today means year zero, immediately. Year zero. So here I will then put 0. That's year 0. Discount factor at year 0 is equal to 1. 1 multiplied by 30,000 is 30,000. Less to reduce the cost. I'll pick the next one. Under outsourcing, we have product and process engineering cost of 8,000 naira for year 1 only. Product and process. Engineering cost, 8,000 naira for year 1 only. So put 1 here. So discount factor, you need to calculate discount factor. How do you calculate discount factor? There is difference between annuity factor and discount factor. Discount factor, DF, at 12%. Okay. So discount factor is calculated as 1 plus R raised to power minus N. So this will be 1.12 raised to power minus 1. So what do you have here? 1.12 raised to power 1 minus equal. That's 0.893. 0.893. That's the discount factor at 12% for year 1. Okay. So I will then come here 0.893. You see the way I'm doing, this is the way it is expected of you on the day of your exam. But you can't just get to this level. You need to expose yourself. This is an exam question. It is expected that you will have covered the syllabus A to Z, the entire syllabus. So you've already gained the skill and knowledge required to do well on the day of your exam. So it's not a day job. That's why it is important for you to practice. You need to practice as many questions as possible so that you get exposed to the techniques and the gimmick of ICAN. All right. You know that once you know the secret of ICAN, and then of course you can solve any question. The secret of ICAN is for you to practice as many questions as possible. There's no other way. There's no shortcut. Just continue to practice, practice, and practice so that you can become master. Next one, or the last one, under outsourcing is storage space. There's a saving under storage space of 2,000 naira per year. So again, there's another saving. Let me just put storage so that to be different from the first saving. 2,000 naira 2,000 naira. We are told that, so this will be, since examiner did not tell you whether it is for year 1, year 2, so it is on the basis of the contract, and the contract is for 5 years. So year 1 to 5, 3.605. Therefore, I would then say 3.605 multiplied by 2,000. That's 7210. 7210. Oh, I've not done that one. 8,000 multiplied by 0.893 equal 7144. Here is 7144. All right. So final answer. A wise student should have gone ahead, add those numbers, and give me once and for all without asking. You want me to do everything?
Hello, sir.
Yes.
Please, the storage space, is it not meant to be in brackets? Is it saving?
Yeah, it's saving, it's in bracket already now.
Yeah, I mean the present value.
Yes, it is. Thank you. It is. Thank you. So total
330434.
330434. Thank you, Oliver. So that's that. The total present value of outsourcing part 2011 is 330434. See, on the day of your exam, the way I've presented what you are seeing on the screen, don't do it like that on the day of your exam. You need to complete your table. You need to rule accordingly. Where you are supposed to rule your table, you tabulate your table properly. Don't leave one side because you are so much in a hurry. You do one side and leave the other side. No, that's not good. That's not a good presentation. So at times, examiner can be happy with you the way you present your work. And if your work is neat, you may imagine. But if you do it anyhow, just cancel your work anyhow. We paint any painting that you do on the day of your exam is minus half. So there is a way in which you can if you make a mistake, there's a way you can correct it. Say for example, you want to write 150. For example, you want to write 150, but you mistakenly write you want to write 100. You now mistakenly write 150. So instead of you to be canceling this, you're saying you want to turn it to 100. When you do this, examiner will just say minus half, minus 1 over 1 over 2, minus 1 over 2. That's half. You cannot imagine if you paint. Some people even paint it worse than this. Okay. So ordinarily what you're supposed to do, you wanted to write 100. You now mistakenly write 150. What you're supposed to do is to just take a cross like this. What are you hiding? Why are you painting it? Just take a cross, then rewrite your 100. So that's okay. No penalty. Nobody is above mistake. All right. So it's clear like this. But when you start painting it, it will make your work look very rough. And then, of course, that's not a good presentation. You are going to earn minus half. You can imagine even one mark can take you to the next level. So if you now have about, let me say, you have about 5 or 10 painting in your answer booklet, you can imagine how much marks you are going to lose as a result of that. So you have to be very careful. So this is for PV for outsourcing part 2011. Let's do PV for internal production. PV for internal production of part 2011. Okay, so the same way you did for outsourcing, description of items, cash flow, discount factor at 12%, the PV. Okay. Now, I will then go back to where I've analyzed the data that I need. Direct material is for all those figures that we have there, they're on the basis of per year. And this contract is for 5 years. So direct material, direct labor, I would then come here, direct material, which is 44,000, direct production labor, 22,000, variable production overhead, 14,000. Then we have products and process engineering of 8,000. Is it 8,000? Let me confirm. Yes, 8,000. That's it. So this is for year 1 to year 5, year 1 to year 5, because all these figures is based on the per annum. So for the next 5 years. So here is 3.605, 3.605, 3.605, 3.605. So you multiply the annuity factor, 44,000 multiplied by 3.605. That's
158, 6.
158,620. Then the next one,
79,310.
79,310. Yeah. 54,7 watts.
470.
470. Okay, the last one.
28,840.
28,840. Add it up.
370,240.
370,240.
317.
317. Oh, okay. 317,240. All right. So that represents the total present value under outsourcing. So the next thing I'm going to do, I would then say savings or deficits from making parts 2011. So this is the point where we are going to compare supplier's quotation versus relevant cost of making. I would then say PV for outsourcing. Let me write that. Outsourcing parts 2011. We got 330, 434, 434. Then PV for internal production. Internal production of parts 2011. We got 317, 240. What's the difference? 330 minus 317 is 13. 434 minus 240.
10,194.
194. So this is the saving. This is the saving. All right. So examiner is now asking you, should DG, all right? You are asked, should DG Limited outsource part 2011? So the present value of outsourcing is higher than the present value of internal production. Therefore, DG Limited should make part 2011. I would then say DG Divine Grace Limited should make part 2011 in order to save 13,194 naira. as shown in the calculation above. If you want to go further, that answers requirement number A. Requirement number B. The examiner is asking you. Yes, talk to me.
Yes, sir. You mentioned earlier that the calculation of the outsourcing part 2011 and the internal production is not the examiner asked. Basically, now is the saving we just did that is the answer to our question, right?
Take it again.
I said you mentioned earlier that the first calculation we did, which was the outsourcing part, getting the figure for the outsourcing part and then the internal production, is not the question, like it's not the solution to the question. So now what we just did, which is the calculation of the saving or deficit, is the actual solution, right?
Yes.
So now my question is that what should come first on the day of exam is this solution of the saving, right?
Yes. No, if you do it the same way I've done it, of course you are good. This is not working. Bringing out all the variables that you need is not a working, it's part of the solution. But for proper presentation, you can start from the saving or deficit from making part 2011. You have those figures. Then you now begin to showcase how you come about your numbers, like all these ones. Outsourcing part 2011, supplying cost, disposal value, product, and all those items. Then, of course, you calculate your PV, you calculate your PV of outsourcing, calculate your PV of internal production. So if you do it the same way we have done it now, of course, you are still in the pro, you are still in line. But if you also start from saving or deficit from making part 2011 to arrive at that 13,194, then you now begin to say all those variables. You are still good to go. But that second part is the best way to present it. All right.
Yes, sir. Thank you, sir.
Yeah. So you can start from here. Start from here first. Savings or deficit from making part 2011, then you make your decision. Divine Grace Limited should make part 2011 in order to save 13,194. Then you now you need to show to your examiner how you come about your numbers. All those variables, you now begin to show them one by one. Bring it out, then you calculate your PV of outsourcing and all of that. Good. At times, you may not know because you don't know the extent that this variables will take. All right. So you may not be able to give appropriate space or line that you are going to need for the main solution so that you don't have a gap. And that's why in this situation, you bring it out first, you solve it step by step the way I've done it. All right, let's move on to the next one. So in the B part of the question, examiner is asking you, okay? Examiner is asking you, what maximum price should KK Limited quote on the 1,000 unit to make Divine Grace indifferent between outsourcing and internal production? 5 marks. All right. This is a very straightforward question. As simple as it is, if you don't know it, you don't know it. There's nothing you can do about it. All right. So examiner is asking you, what maximum price should KK Limited quote on the 1,000 unit to make Divine Grace indifference between outsourcing and internal production? You remember earlier today, last time when we started this make or buy, I mentioned to you that I gave you the decision rule. The first decision rule is if the supplier's quotation is greater than the relevant cost of making, then you should advise that the company should make. Number 2, if supplier's quotation is less than relevant cost of making, the company should buy. Then number 3, if supplier's quotation is equal to relevant cost of making, the company can make or buy depending on other qualitative factor. So if supplier's quotation equal to relevant cost of making, that means the difference is equal to 0. So that is what the examiner is asking you in this number B part. What maximum price should the supplier quote for the 1,000 unit to make the company be indifferent between outsourcing and internal production? When you are indifferent, that means you are neutral. That neutral will represent break even. You want to break even. What price should KK Limited quote that will make DG break even? DG does not want to make profits. It will not also make loss. You want to break even. So in this case, how will you be able to determine this? That means you are supposed to use sensitivity analysis. You know, as we proceed, under risk and uncertainty, we are going to discuss, it's a topic on its own, risk and uncertainty. One of the methods of hedging risk is sensitivity analysis. The sensitivity analysis measures the tolerable extent to which a project NPV can accommodate any change in variables. All right. What we are trying to say here is the fact that you want to determine maximum price that will make KK Limited that KK Limited should quote. You know, currently KK Limited quotes 100 naira for the 1,000 units of the supplying cost. So KK quotes 100 naira. So that 100 naira included both the cost and also the margin that the KK Limited will earn in supplying the 1,000. So what price should KK quote that will be break-even such that the supplying cost will be equal to relevant cost of making part 2011? So in this case, you want to determine the price that KK should quote that will equal to 0. That will be equal to relevant cost of making it. So such that DG will be indifferent. DG can decide either to buy, either to outsource it, or to make it. All right. So in this case, all you need to do is to determine the sensitivity analysis. And the sensitivity margin of supplying costs will be computed by taking the ratio of the savings or NPV to the present value of the variables. So this is what I'm trying to say. Number B, maximum price. Okay. I would then say the maximum price that KK Limited should quote for the 1,000 units is the maximum price that KK Limited should quote for the 1,000 units will be calculated as follows using sensitivity. You will appreciate sensitivity analysis more when we get to risk and uncertainty using sensitivity analysis. Okay, like I mentioned to you, sensitivity analysis measures the tolerable extent to which a project NPV can accommodate any change in variable. If you reduce the supply cost by a specific percentage, okay, what impact would that have on the 134, on the 13,194? So you want to quote the price now, the price that KK Limited will quote now, that will erase this 13,194, such that 13,194 will be equal to 0. What you have as your relevant PV of your relevant cost of internal production and the PV of outsourcing will be the same thing. The figures you have here, the price that the company should quote that will make your total that you have here and the total you have under outsourcing be the same. Is what the examiner is asking you to do. Indifferent means you are neutral. You want to break even. Okay. So let me quickly complete this before my system will go down. All right. So I will then come here. Let me even check. Okay. So I will then come here. Maximum price. The first thing you need to do, you need to determine the sensitivity margin. So I would then say sensitivity margin of supplying cost, because the variable is the supplying cost. So the formula is, when you want to calculate sensitivity, you can calculate sensitivity margin for any of the variable. It could be initial outlay, it could be the cost of capital, it could be the project life, it could be revenue, it could be fixed cost, it could be savings, it could be anything. But examiner was specific. Examiner is asking you to calculate the price on the supplying cost, the price to be quoted on the 1,000 units, which is the supplying cost. So in this case, this would be NPV divided by the present value of supplying cost. Everything multiplied by 100 over 1. So let me just manage this space, equal to our savings now is 13,194. Present value of supplying cost is 360,500. That's what we got in our calculation above under outsourcing. Okay. This is it. That's 360,150. Sorry, 360,500. So multiply by 100 over 1. So what do you have there? What do you have? 13,194 divided by 360,500. Let me use my calculator. I don't know if we are still together. 13,194 divided by 360,500 multiplied by 100%. That's 3.66%. Here is 3.66%. So this is the tolerable extent to which this savings of 13,194 can accommodate any change in supplying cost. So the supplying cost of 100 naira per unit can reduce further by 3.66% in order to be indifferent. So let me continue from here. So I would then say price to quote, maximum price to quote. Maximum price to quote. Okay. So the current purchase price, from KK Limited is 100 naira. All right. Then you less the reduction. There is a reduction of 3.66%. 100 naira multiplied by 3.66%. Okay. This would be 3.66. 3.66 minus 100, that's 96.34. This is the price that KK Limited should quote that will make DG indifference. Okay. I would then say the maximum price that KK Limited should quote to make DG Limited indifferent. When you're indifferent, that means you want to break even. You want to be indifferent between outsourcing and internal production. Is 96 naira 34 kobo. So you can practice this on your own. What you are going to do here is that, what we are seeing here is that this 96 naira 34 kobo is the price that KK Limited should quote on this supplying cost. The supplying cost is, originally the supplying cost is 360,500. So, you know, we got this 100,000 the 100,000 supplying cost. We multiply 1,000 units by 100 naira. Now that the price has reduced to 96.34, so you multiply 96.34 by 100, that will give you 96,340 naira. So if you find the discount factor, if you can find the present value of that 96,340, of course, it will be less than the 360,500. Then you consider this, you consider this, you consider this. Whatever answer you are going to have at the end of the total you are going to have here must be equal to the total that you have here, 317,240. When the two of them equal, then the DG can decide either to make 2011 internally or outsource it. That's what the examiner wants you to do in that one. And that's end of the question. That's end of the question. So number C part of the question, the examiner is just asking you what non-quantifiable factor would favor internal production rather than outsourcing. Okay, so let me just show you how I answered that. Let me stop sharing this. Let me know if you have any question for me. I think this is the last question we are going to solve today. But let me just show you. Let me show you. Let me open to the ebook and show you how I answered the number C part or the entire question. Okay. PM learning material completed topic. I want to show you. Okay, let me share my screen quickly during the next 2 minutes. Let me know if you can see my screen.
Yes, we can see your screen, but we are seeing a different thing.
Can you see my screen?
Yes, sir, we can see it.
What are you seeing on the screen?
Optimal product mix decision.
So yeah, that's what I want to show to you. I just want to show you how I come about the, which one is this one? Okay, this is let me go back to the question. This is it. So this is the question we just finished solving. This is the question we just finished solving. All right. So I want to show you answer to the number C part. Now, like I was trying to tell you the other time, you have to show your assumptions, all the assumptions that you have made. It's not sufficient for you to just ignore some numbers and pick the other figures. Why did you ignore those ones? So you need to state all your relevant assumptions. Then, of course, the C parts, examiner is asking you, what are the factors? What are the non-quantifiable factors to be considered? The following qualitative factors will need to be considered by management of DG Limited before making the final decision. Number one, you need to ask yourself, do we have the required manpower to manufacture part 2011 in addition to the existing products? Okay, remember what I told you. Whenever you are stating your assumption, you need to relate it with the question. You link it with the question. Don't make it too generic. Don't just cram qualitative factors and then you dump it on the day of your exam. Okay, so you need to relate it with the question. Number two, DG Limited will need to ascertain if there's requisite in-house technical know-how or expertise to produce part 2011. That second factor you need to take into, remember, it's 5 marks. So you need to maximize, you need to ensure that you score the entire 5 marks. All right. In the assignment I gave to you that expired or that was due for submission last Wednesday. Some of you are just giving a kind of assumption and just copy and paste with the way I gave it to you. No, it's too generic. So you have to avoid that going forward. Now, number three, internal production may be favored over outsourcing to maintain better quality control to satisfy customer demand. That's another factor you need to take into consideration. And number four, the company we need to ask, do we have sufficient in-house storage capacity that can accommodate Part 2011. All right. You know, examiner also mentions storage space in the question as well. So you relate it with the question. Number 5, outsourcing Part 2011 may result in labor disputes, which can impair the reputation of the company if not properly managed. Yes, if, say, for example, the company is already producing Part 2011, when you now decide to outsource it, the workers that are operating on Part 2011 or that are producing Part 2011, they will not be happy. They can raise up, they can go against the company, the decision to outsource it, because the union may protest and they disrupt the activity of the company. So you need to manage any negativity that may arise as a result of outsourcing Part 2011. Then number last, the impact of outsourcing the Part 2011 on workers' morale should be considered, because this can result in low productivity, because the workers that are operating in other areas of the business may become apprehensive of job loss. As a result of that, it will lower productivity. So, and that's why it is important, before the final decision is taken, you need to consider the effect of outsourcing Part 2011 on workers' morale. Okay, so these are all the factors that needs to be taken into consideration as far as this question is concerned. So this is where we are going to call it a day. In our next class, by the grace of God, we are going to do acceptance or rejection of a special order, and that will be the last area we are going to touch in short-term decisions before we move to optimal product mix. So finally, let me hear from you if you have any question for me before we close the class for today.
Yes, sir. Please, my question is under Sangotedo.
Yep.
The variable overhead, how you arrived at that 0.5. But I was thinking it's 0.15.
No, it's 0.05. You know, in the question, your total overhead is 1 naira 50 kobo, isn't it? Your total overhead is 1 naira 50 kobo. And I said that total overhead is irrelevant, because if you are just giving total overhead, no additional information, just ignore it. It's irrelevant. Only variable overhead is relevant. Therefore, you then go to the question, how do you determine, is there any indication in the question that will help you to determine your variable overhead? Examiner told you in the question that there's a fixed cost of 100,000 naira at activity level of 100,000 boxes. So that means fixed overhead per unit per box is 1 naira. That is 100,000 naira divided by 100,000 boxes. That's 1 naira. So total overhead is 1 naira 50 kobo. Fixed overhead is 1 naira. That means variable overhead is 50 kobo. So now you are told that variable overhead will reduce to 10%. Therefore, 10% of 50 kobo will give you 5 kobo. That's it. That's how we got the number. All right. Let's see.
Okay, thank you, sir.
You're welcome. Yes. Any other question?
You can check the message box as well.
Kindly share. That is a normal thing. Moses is asking that we should share the recorded version.
Let's see the detailed head of this note, please.
Which note? The one I'm sharing?
No, not the one, the working note. Just for us to copy the
no worry, I will share the working notes now. I will share it. Also, danger of releasing. Okay, Latif is given another additional information, additional factor. Also, danger of releasing production secrets is also irreliable. Of course, you need to include it. The degree of secrecy, or the need to protect the degree of secrecy or proprietary technology underlying Part 2011. Okay, that's another factor. Fantastic, Abdulatif. Yes. Okay.
Good evening, sir. Mr. Juma.
Yes, who's speaking?
Okay, this is Moses.
Okay, Moses. Yes.
Right, like I asked in the chat room, like what I wanted to ask was, is it possible that after sending the work notes, that you send your own record, the one with hearing your voice and how you arrive at all these things? Because copying notes and listening at the same time will help a lot.
It doesn't work like that. There are other work that will be done behind the screen. Behind the screen, it's not something you can just you finish class now immediately you send the recorded note with the material. It doesn't work like that. There are times the student might have joined the class even 30 minutes before the class, and the thing will just be recorded. We can't share in the public all those ones that are empty. No recording. I mean, no classes were going on. Just students were just discussing privately on their own in their own location. So the editor will need to cut those areas before it is being shared. So it's not something that will be just immediate. As I'm done now with my class, then immediately we share it with the notes. It won't work like that. And that's why on each lecture day, the first thing we share, okay, we share the notes. You have so that you can follow through. You can still remember all those things the way we solve any question or what we discuss in the class. Then maximum a day after you get your recorded version, which of course is just a way of supporting to provide additional support to your learning. Yeah. So you like you requested, Moses, you having the recorded version together with the notes will not work on the same day, except that you want us to delay sharing the I understand your concern. So except that if you want us to delay the sharing of the material, that is, instead of sharing the material now, we delay it until when we are sharing the video. That's what you want. So if that is okay, no wala. But again, there are some people that are also of the opinion that, oh, I'm writing as I'm talking now. Some people are jotting down, are making their notes. So they want to confirm what I have written down in my working notes. So that's why I usually share with them immediately after the class so that they can complete that. Like Oliver was asking that I should scroll down in the notes, want to write down something. So I said, oh, I will share with you. So different people with different concerns. So that is that, Moses, you can't have the two at the same time for now. All right?
All right, sir. All right.
Okay.
No. All right, sir.
Yeah. So any other questions so that we can close the class? Okay. So thank you guys for joining the class. That's from me to you. I will see you next time by the grace of God. Please keep reading. Time and time wait for nobody. Your exam is around the corner. It's important for you. If you have not started reading, we'll be saying it almost on a daily basis. There's no better time for you to start other than now. You think that your May 22nd, when you are going to start your exam, is still very far. No, just like yesterday when we started this year, 2025, today is February 9th. Before you know it, it will be end of February. So guys, you need to double your efforts. You need to double your efforts. Maximize, let your money work for you. Your lecture fee, your exam fee, let everything work for you so that at the end of the day, you are going to have a beneficial outcome. Like I said, there is no two way about it. If you read, if you practice as many questions as possible, this will help you to gain your confidence. All right, it will boost your confidence going into the exam hall. In fact, by end of April, you should be calling on the examiner that, oh, I want to be tested now because you are ready. The confidence is so high. But if you are dilly-dally, you are not, you don't study at the appropriate time, and you still have so much backlog of topics to cover, then you'll be wishing that the examiner should postpone the exam or should delay the exam. So you don't want to put yourself in that position. Please, it's important. You need to start reading now. You need to start reading. All right. So that's it. We are going to meet again next week by the grace of God. Bye bye, everyone.